Everyone, we're here at the Las Vegas Traders Expo sitting down with Tom Lee. Tom's the co-founder and director of research for Fundstrat based in New York.
Yep.
Tom, thanks so much for joining us. Really appreciate it.
Thanks for having me.
So just if you could, to introduce our viewers to you and your background, what has gotten you to this point? What have you been doing up until this moment?
Well, I grew up in Michigan. When I was a kid, I watched Family Ties, so I was kind of interested in being I forgot
Alex
Michael
Keaton?
J. Yeah, Alex Keaton of the world. So
Yep.
I went to Wharton undergrad.
Okay.
I fell in love with equity research.
Got it.
So I graduated, and my first real job was at Kidder Peabody in 1993, doing stock research for telecom services.
Okay.
But the area I was actually assigned to was wireless.
Mm-hmm.
I had a great boss, Steve Yannis, but wireless was a growth industry back then. Didn't make money. It really taught me about how important it was to understand how equities are the junior piece of the capital structure.
Right.
So that's always followed me, throughout my career. But I've essentially had the same job. So from Kidder Peabody, I went to Solomon Brothers, and then ended up at JP Morgan, and then in 2007 became chief equity strategist. Did that for many years, enjoyed that a lot, and 5 years ago started Fundstrat Global Advisors. So we're 5 years and strong, clients in 16 countries, almost exclusively hedge funds and long-only managers.
Right. Congratulations on that. I mean, it's fantastic success leading an independent shop like that. It's really well done.
Yeah.
Can you talk a little bit just about the transition? I mean, obviously the financial industry has gone through so much transition over the years. I've been in the industry for about 19 years, and just in that time, it's been a lot. Can you talk about the transition from traditional kind of broker research to more independent research shop? Because that's a move that has happened. I think it's more of a sea change, right, in the industry?
Yeah, it's a sea change, and I think part of the reason is one. Research is actually a real value capture business. That meaning if clients really value the relationship, and generally most buy-side managers only use maybe 5 services or sources for anything they do, whether it's stock selection or macro. And if you're top 3, you really capture the lion's share of that wallet or vote.
Yep.
But if you're at a large firm, a lot of that effort gets lost in everything else that happens. And so as an independent research analyst, if you've got really strong relationships, it becomes quite a good business, and it's great for customers because you're conflict free. I mean, we're a completely conflict free firm.
Right.
Clients know the only thing we're dedicated to and the only reason we survive is putting them on the right side of history.
Yeah.
Like, we don't care about being right or wrong. We really want them on the right side of the market, and that's our job.
That's great.
Yeah.
Now, Fundstrat, from my experience during my Fidelity days, we consumed a lot of Fundstrat research, like looking at the different strengths and weaknesses of different perspectives. Your firm strikes me as one that combines the fundamental with the technicals. You have Rob Slimer that works with you, who I know very well. Can you talk a little bit about that hybrid approach or that fusion approach, and how you would expect institutional investors to combine those different inputs in a meaningful way?
Yes, I'd be glad to. So, sort of the cornerstone of our Fundstrat framework is one that stocks are the junior piece of the capital structure. That means, markets really are good at telling us what should be happening. So we don't try to tell the market what to do. We want to understand what's really happening in markets.
Right.
And, in my 27 years being a fundamental analyst covering wireless, I've learned that that part of the language of markets is really understanding what price is telling you. So I think technical analysis is a completely valid way to understand market narratives. I've been a big fan of Robert Prechter and Elliott Wave, Richard Russell and the Dow theory.
Sure.
And even market timing systems like Tom DeMark. I mean, these are really, really valuable, and even common sense things like 200-day moving averages are really critical. I mean, markets behave very differently when they're above trend and below trend. So even though we're totally fundamental at Fundstrat in terms of our market view and framework, and it includes a lot of demographic work, technicals are central. And in fact, I wish I was better at that. And that's why we have Rob Slimer.
There's always room to improve, right?
Yeah.
So that's great. So at this point, we're recording this sort of, beginning of November 2019. The S&P going to new highs, continuing to do so. There are, a lot of macro factors that are, potentially causing that. At this point, with the market going to new highs, but up until now, it's been a lot of defensive leadership. It's been utilities, real estate, things like that. How are you thinking about going into year-end, beginning of next year? How do you think of it from a holistic perspective?
Yeah, well, I mean, 2019's clearly been a very difficult year. Because if you were just following sort of headlines, then you were looking at tape bombs like trade war, impeachment, Brexit, inverted curves, record debt levels, but yet the market is on track for really its best year in over 22 years. Okay,
Isn't that
so
wild?
so in a career you'll never see a market this good. And I think that the reason the market was defensive-led was people were thinking this is late cycle, it's liquidity, and so they were buying defensives. But something's happened, and I think what's happened is, and we're seeing it, the PMIs have bottomed. So instead of us having an industrial recession that's tipping us into a global economic recession, it's really an inventory drawdown that's now starting to revive. You know, the ISM exports number went back above 50. We're talking the global economy is sort of kicking into high gear again. So it's a earnings recovery that the market's been discounting all year. This is an authentic breakout, and we think it's the start of a new cyclical bull market.
Fantastic. Do you have any projections or expectations about where we would see the S&P going into next year?
So some rough framework. So you know, by the end of this year, I think 3,200 is probably a reasonable target because we're hitting the Santa Claus rally.
Yeah.
But we did this study, and we published it many times this year, that the market's been nowhere for 20 months. So for 21 months, it's been stuck in a range. Since World War II, it's happened 3 times. 3 of the 3 times, these resolved with a massive upside breakout, with an average gain of 50% over 2 years.
Right.
So this is telling us, this upside breakout, S&P probably is 4,500. Now, that sounds insane.
Right.
But keep in mind, if you look at S&P since 2017 to now, has only compounded at 7% a year. Earnings have compounded 11.
Right.
So the stock market has trailed earnings growth, actually. So I think 2019 is sort of a year of catching up to where earnings have grown.
Interesting. Now, you mentioned demographics a little bit ago. I'd love to, you know, obviously in the U.S. where, you know, the baby boomers are starting to retire, that's, you know, has a lot of potential implications between, you know, people raising cash or people being in equities, people getting defensive flows, all of that. What is your work telling you about demographics, and how should investors think about those in the coming years?
I think there's been too much focus on retirements of boomers. Because, you know, what happens is that when people age, they have household wealth and then they have consumption. And their consumption dynamic actually shrinks because, you know, they're not borrowing money anymore. And if you look at Chase credit card data, once you reach past 50, year over year your credit card spending actually starts to decline. So they're not the driver of the economy, but in the US there's $100 trillion of household wealth, largely controlled by a 20-year age generation, which is the boomers. So that's $100 trillion. That money now is going to start to be inherited by the Gen X and the millennials. And the estimate is around $7 trillion just to the millennials in the next 5 years. So that's 7% of it being transferred. Millennials all of a sudden get $7 trillion, which is, remember, it's like almost 50% of GDP.
Right.
It's money for down payments. Millennials, credit card consumption's rising. They're entering the prime income years. Between the ages of 30 and 50 are the only people who borrow money.
Right.
The wave of millennials is so large, it's actually, the 30 to 50-year-old age group is accelerating at a pace you haven't seen since the 70s. So the U.S. is probably entering a real uptick in real GDP growth that most people don't realize, and that's why the U.S. economy has been decoupling.
Right.
So it gets us, as a framework, really bullish for the next 5 to 10 years for the U.S.
So with U.S. equities, you know, apparently, you know, according to demographics, seems to be plenty of tailwinds for that. And you're fairly optimistic. How do you think about alternative asset classes right now relative to equities? If equities look so attractive, how should investors be thinking about bond allocations, even cryptocurrencies, real estate, sort of commodities? How do you sort of think of that relative to this bullish equity perspective?
Yeah, you know, today, you know, when people think about asset classes, they'll really roughly just throw out 3: stocks, bonds, and commodities. And, you know, and if you're really rich, real estate and art. But nobody really flips between art and stocks, right?
True.
And art and homes. So there's really stocks, bonds, commodities. 20 years ago, commodities was not part of the allocation.
Right.
Commodities only really got validated because the market for commodity investing got large enough, so it became an institutional story. Digital assets, to me, is going to be the 4th asset class. Because digital assets, which really encompasses today cryptocurrencies, and it's really Bitcoin that's the most relevant, actually is really useful. It's a great way to transmit money. It's a great way to store value. It's decentralized trust. It's immutable, and there has never been a hack on the blockchain. And it's a real network. It's a network value or network effect asset. So as adoption grows, its value grows, and it's actually traceable. 70% of the move can be explained by that. So I think as adoption of cryptocurrencies grows, it's going to become a legitimate asset class, and I think people need to put 1 to 2% in it.
Right. With cryptocurrencies in particular, I know on stock charts, looking at crypto data from a technical perspective, that's really our focus. One of the, I would say what some people think the benefits is there's limited fundamental data in general, right? It's very much, in some ways, a petri dish of behavioral biases and everything, but how do you think of it? Is there a good way to think of it from a fundamental perspective that marries that with the technical, looking at the charts of Bitcoin and Ethereum and whatever else? How do you approach it, generally speaking, from a fundamental perspective? How can we think of it that way?
Yeah, I mean, I think there's a true economy measurement for crypto because one, there's the blockchain, so you can measure what's happening on the blockchain.
Okay.
And even though there is a lot of noise, and that's why services like Coin Metrics or Digital Assets Data, they try to do their best job to sort of clean up the way the blockchain's reported, especially in Bitcoin, because there's the double outputs.
Right.
You can measure activity there.
Okay.
But as adoption of cryptocurrencies generally grows, like through Bakkt and the idea that Starbucks now will start to use as a payment channel, you're going to have a real economic measurement because you can start to measure transactions. So I think that the whole concept of measuring Bitcoin's economy is not well measured today because it's hard to measure the movements, but you only see the residuals to the blockchain. So I think it's just a matter of time. But I think there's, in our work at Fundstrat, we have shown there's, simple measures that have explained a lot of the moves of Bitcoin. So one is mining and break-even costs, and the other is really wallet movements. And so even just those two simple measures really can put you on the right side of Bitcoin moves. Fundamentally.
Right. That's great. I'd love to pivot just a little bit, if we could, talk about a little bit more about your process, your routines. How do you, approach the market? So do you have a set process that you follow every day, every week, or some sort to sort of orient yourself? And the reason why I'm asking is because there's so much of an information overload now, right? We have so many different inputs we could pay attention to. Yeah. So much data. Do you have a general way or any guidance you could give our viewers about how you approach things in a way that gets you to the thesis?
Yes. I mean, I think in general, one of the dangers when people look at markets is there's two things. One is that they're looking for narratives, and so that means that people will often take price move and then attach it to a news event, or they'll attach it to some sort of trend and anchor that view. And I think that the reason it gets dangerous is 2019 is a perfect example. If you were just looking at the headlines, you'd have recession mania. And in fact, we say that everyone's got a 2008 hammer looking for 2008 nails. But if you had a process, and at Fundstrat's process, it's really, the business cycle is what we think is the most important arbiter for the equity markets. We had a lot of fundamental models that we've been sharing with our clients and have argued forcefully this year we're only mid-cycle. Okay. So no matter what people thought about what was happening in credit and the curve and in repo, the real measures of economic maturity we're saying mid-cycle. And I think that as we exit this year, our models have proven to be really robust and they've been correct.
Right.
So I think it's been key to really have an independent way to understand markets that's not driven by either consensus or price only.
Right.
And in crypto, we do the same thing. That in the Bitcoin world, it's in the earliest stages. I mean, it's less than barely 0.1% of all liquid assets. I think there's only 500,000 users of Bitcoin.
A little bit of upside there, right? Potentially.
Yeah, and so what people will, I think, make a mistake is thinking that the first 500,000 users is what the next 5 million look like. Whereas our process, which includes a lot of demographic work and really trying to understand flows and global money flows, is making the judgment that the next 4.5 million users are not coming from where people think they're coming from.
Right.
And that's why we're a lot more bullish on Bitcoin.
Okay. I love to ask people what their one chart is, and I'll explain it, and then give you a little bit of leeway, because I know you come from a fundamental orientation. You know, I always ask people if there was one input, if you had one chart or one set of data that if you had nothing else but just one way to sort of gauge where things were going, what would it be and why? And I usually ask from a chart, but is there a particular specific input or one thing that would, you know, again, if that's all you had as a way to sort of get a sense of where the market was headed?
And are we talking about cryptocurrencies or equities?
Oh, it could be equities, could be cryptocurrencies, whatever you prefer.
Well, you know, in cryptocurrencies, I think the best measure and the most useful thing to watch is the Bitcoin Misery Index. Okay. Which is our internal model, and we don't share it.
Right.
But it's really called the turns very well. Like, you know, it got us really bullish in November 18. And in end of July, it said that the market was overly ebullient, and so we went risk off. And as you know, Bitcoin's kind of stalled since then, and it recently just got bullish again.
Interesting.
But if I didn't have the access to the Bitcoin Misery Index, so through stock charts, I think the most useful lens to look at Bitcoin is through the price to 200-day moving average.
Got it.
And as long as it's above its 200-day, you want to be long Bitcoin, and when it's below it, you got to be cautious.
You know, and that's such a simple approach, but a lot of times I found the simple ones are the ones that are robust, and they persist over multiple cycles, right?
Yes.
What about for equities in general? Obviously, you have a very positive call on the market. What is there one thing that you would look at to get a read on the equity environment?
You know, we just look. We really use a constellation around equity markets.
Okay, sure.
But if I had to say, you know, if I had to wake up and I could only rely on one chart for the stock market every day.
And I know this is a brutal question.
It's tough because
I'm glad I don't have to answer this question that I ask other people.
But I do want to help folks. You know, I think that, okay, so let's just say I think that for your viewer, you know, you want to just know when you need to be long and when you have to get out of stocks.
Sure.
Okay. Because, you know, and you don't want to miss the 10 best days in any market.
Totally fair.
Because, for example, in Bitcoin, if you don't own Bitcoin on the 10 best days of any year, so the other 355 days, you've lost money. Your average return is minus 25% a year.
Wow.
So Bitcoin makes all of its gains in 10 days. And, you know, we witnessed it this past month. Bitcoin was up 30% in a day. In the equity world, if you had to be systematic on timing like that, I think the best single metric that would have served you well since 1920 is the 30-year minus 10-year yield curve. You want to stay long in stocks until that inverts.
Right.
And if you did, you avoided every major drawdown, including 87. So, so it's a long cycle. It's started this year, uber bullish. So the 10-year 30 was one of our sort of secret models for our clients, and that's why that same curve, and we can timestamp because we showed our clients, it told us the PMIs would be under 48 by September. And what was the print? It was 48 by September. It literally beats economists, and it told us to be looking for the cyclical downturn, and it's now saying be super bullish. It's
really, really interesting, and I love about that. What I love about that is it's a very long-term orientation. I found a lot of people get so caught up in the short-term movement, especially when volatility increases. So having a long-term perspective is perfect. We're almost out of time. I'd love for you to tell us, someone just getting started, trying to understand the markets, trying to approach them and think of all the different things available. What would you tell them, or maybe a different way to ask is there something you could teach the Tom Lee just getting started in the industry? What's something you've learned that you think would help you get started?
I'm going to assume that a lot of the folks here really want single stock, you know, to pick stocks. And I was a stock analyst for half of my career. I mean, in fact, you know, I was quite successful. I was institutional investor 1, 2, or 3 continuously from 1998 through 2013. So, and top 1, 2, or 3. So, you know, I understood and respected stocks enough to let the stocks tell me what to do. And I think one of the things I've learned is you always want to buy a quality name.
Right.
It's better to stick with quality.
Yeah.
Like you don't want to try to get the lottery ticket stock. The way you make money in stocks is you got to be long-term greedy, find good businesses that grow, and that is compounding to you through the earnings per share. So
right.
Pick good names, quality names. Don't pick junky little $1 stocks. You know, it's okay to buy a $40 stock with a 20 PE but growing 20% a year.
Very good guidance for all investors, I would argue.
Yeah.
Tom, this was such a pleasure. Thanks so much. Really, really interesting to hear about your background and how you're approaching things. Thanks so much.
Great. Thanks,
folks. This is Tom Lee, the co-founder and director of research at Fundstrat in New York. Thanks so much.